Silver isn't telling you the truth on the screen right now. The spread is, and that asks exactly why the usual crowd is trying to wave this move away as another speculative spike. Because if you look at what's happening under the hood, this isn't just buyers getting excited. It's a market being pulled forward by the need for metal now, not later. And that changes the game for shorts, for dealers, for everyone who's been living comfortably inside the old pattern. And before we're done, you'll have three things locked in. The hidden detail most people miss when they talk about inventory, the calendar trigger that makes the next 1 to 2 weeks unusually dangerous for both bulls and bears, and the exact price zones that decide whether this turns into a controlled retest or a continuation squeeze that can gap on you when liquidity thins. Because here's the reality. Silver has been living near record air, pushing into the low 90s with spot hovering around the high 80s to around $90, depending on the moment, after an already historic 2025 run. And that alone is enough to make the crowd emotional. But emotion isn't what moves a market like this. Mechanics do, and that's where the real pressure starts. The pattern that mattered wasn't some pretty line on a chart, it was the behavior. For years, silver's been the get loud, get slapped metal, breakout, attract momentum, then snap back when paper supply overwhelms demand on the screen. That's the pattern. That's the conditioning. So when price pushes above a prior ceiling and doesn't immediately fold, it forces everyone who has been leaning on that reflex to do something they hate doing. Update their risk in real time. Not debate it, not tweet about it, actually update it. And when a short has to update risk in a market with delivery risk and rising margins, that isn't philosophy. It's math. But that's not even the hidden part yet. The hidden detail is that most people keep quoting cargo inventory like it is one big bucket of silver sitting there patiently waiting to be sold to whoever wants it. It's not. The only inventory that matters in a delivery-driven moment is deliverable inventory. And deliverable is a category with rules, warrants, and owners who may have zero interest in bailing out the paper market at any price. That's the detail the mainstream misses because it's not sexy. But it's the detail that can turn a normal rally into a structural problem. And if you've been in metals long enough, you already know where this goes. Price discovery doesn't break with a headline. It breaks when the cost of immediate metal rises relative to paper promises later. That is why you keep hearing the same word pop up from people who actually watch structure, backwardation, and yeah, it sounds technical. Good. Because the market is being technical right now. In a normal world, time costs money. You buy spot, you pay to store it, insure it, finance it. So futures usually trade above spot. That's contango. It's basically the market saying, metal later should cost a little more than metal now. Backwardation flips that. Spot costs more than futures. The market is saying, no, metal now is the scarce thing. And when silver shows that kind of inversion, it's not a vibe, it's a signal. It's the market charging you a premium for immediacy, and that premium forces behavior. Because if you're short futures and the front end is tight, rolling your position gets uglier, delivering becomes a real conversation, and suddenly that short isn't just a directional bet, it's a logistical bet. But that's not the part that matters most. The part that matters most is what this does to the people who provide liquidity. Dealers and market makers live on spreads and hedges. They're fine when the curve behaves. They're fine when they can source metal or hedge exposure cleanly. But when the curve screams tight, liquidity thins, and the market starts to punish anyone who's casually short the front end. And then something else happens that most retail investors don't fully appreciate. Volatility becomes a weapon. Not because there's a villain in a cape. Because volatility forces risk managers to act. It forces margin. It forces deleveraging. It forces people out at the worst possible moment. And that's why you need a psychology shield before you need another hot take. Because the market is going to try to shake you out whether you're right or wrong. That's the job. Now, let AS connect this to the title in a way that actually holds water. Shorts cover as physical pulls metal. Shorts covering is real, but shorts don't cover because they suddenly had a spiritual awakening about silver. They cover because carrying the position becomes too expensive, too risky, or too operationally messy to justify. And physical pulling metal is real, but physical isn't just someone buying a few coins online. Physical is industrial demand. It's ETF creation when shares have to be backed by bullion. It's bars moving between vaulting systems. It's delivery notices. It's refiners. And fabricators trying to secure feedstock. It's premiums rising in the real world because available product is constrained. And here's your first proof stack layer. The real-world symptom set has been getting louder. When a market is loose, you don't hear about delays, you don't hear about premiums biting, you don't see the scramble for specific bar formats. You don't see people swapping what they want for what they can get. You see smooth flow, tight markets get noisy, they get messy, they create friction. And that friction is information, but that's not the only proof point. Because proof stacking isn't one trust me bro anecdote. It's layers. The second layer is market structure itself, the curve behavior, the front month premium versus later months, the cost of immediacy. If spot trades above futures, it's telling you the physical desire is immediate enough to overwhelm the normal carry costs. That's not common in calm conditions. The third layer is inventory categories, the hidden detail. People love to say, COMEX has X ounces in warehouses, like that's the float. It's not. Warehouses report categories like eligible and registered. Eligible means the metal meets specs and sits in approved vaults, but it's not tied to a warrant for delivery. Registered is the deliverable pool tied to warrants. That distinction is everything in a squeeze conversation. Because eligible metal can be converted to registered if the owner wants, and the owner may not want, especially if they sense the market is stressed. That is the part that turns there is plenty of silver into Dangtukar. There is plenty of silver, unless it's not for sale. And that's where the real pressure starts. The fourth layer is institutional flow, and I'm not talking about one guy on TV. I'm talking about flows that require metal. Silver ETFs can be a slow drip until they aren't. When flows flip from outflows to inflows, the machine can become a vacuum. That's not a moral statement. It's a mechanical one. If a trust has to be backed by bullion and creations accelerate, you get steady bid pressure that doesn't care about your chart pattern. It cares about shares and metal. The fifth layer is global arbitrage. When physical starts migrating between major hubs, London versus New York, or shifts driven by policy tariff fears or demand surges, one pool tightens to relieve another. And whenever you see that kind of cross-venue tug of war, it messes with price discovery. The screen price is supposed to be universal. But if the physical logistics and rules create friction, you get regional stress. You get premiums, you get weird spreads. And that's where the price is lying. Spread is telling the truth frame becomes more than a catchy line. It becomes a way to survive the noise. Now, I want to make this extremely clear because credibility matters. None of this guarantees silver can de-dump 10% in your face on a random Tuesday. It absolutely can. In fact, in a market like this, it's almost a requirement that it will. Because that's how leverage gets cleared, that's how weak hands get removed, that's how trend becomes durable, and if you don't build that into your thinking, you become exit liquidity for someone who does. But that's not the part that matters. The part that matters is what the current setup forces participants to do right now, this week, and into the next couple of weeks. Let's talk shorts and margin, because this is where the covering story gets real. A standard COMEX silver futures contract is 5,000 ounces. If silver is around $90, that's about $450,000 notional exposure per contract. That's the first thing people forget when they play with futures narratives. It's big. The second thing is margin. When volatility spikes, exchanges raise margin requirements or shift margin methodology to keep the system stable. And that change matters because it affects who can stay in the trade. If margin is, say, roughly in the high single digits of notional, you're talking tens of thousands of dollars per contract in margin. Now imagine a $5 move in silver. On 5,000 ounces, that's $25,000 P&L swing per contract. Not theoretical, real. And when silver is making moves like this, risk managers don't care that you have a thesis. They care that the position is stressing the book. So shorts face two pressures at the same time, price going against them and funding a hard margin pressure increasing. That's the margin spiral mechanism in plain terms. And here's the micro cliffhanger you need to keep in mind. If the wrong level breaks, the margin math changes. Because once a market prints new extremes, VOL assumptions update, margins can update, and forced buying can appear out of nowhere. Not because everyone decided, but because the risk engine decided. Now layer in physical. A short can sometimes just roll. Sell the next month, buy back the front month, keep the short alive. But in backwardation, rolling can be painful. Because the front month is expensive relative to later months. The curve is charging you to stay short up front. That's why backwardation is a stress signal for short positions. It's the market saying, pay up if you want immediacy. And if the curve stays inverted long enough, it turns into a tax on shorts. So what happens? Some shorts cover, not all at once, not in a neat line, but enough to change the tone. And that's when you start seeing what looks like irrational upside. It's not irrational, it's forced. That's the difference between a hype rally and a squeeze-prone rally. And yes, I'm using squeeze language carefully. This isn't a cartoon conspiracy. It's incentives and constraints. That's it. Now, about the physical pulls metal part. Physical pull shows up in places people done a T-track because it S not in the trading app. It shows up in the curve. It shows up in premiums. It shows up in shipping and availability. It shows up when fabricators start substituting when they can. And that's a key counterpoint you have to respect. At very high prices, industrial users don't just accept the bill. They adapt, they thrift, they substitute, they redesign. That's not bearish propaganda. That's a real demand response mechanism that can cap a rally if it becomes widespread. But here's the twist. Substitution is not instant. It's not free. It has lead times, testing, reliability issues, and supply chain constraints of its own, which means you can have a window, sometimes months, where demand stays sticky even as price screams. And in that window, tightness can get worse before it gets better. And that's where the real pressure starts. Now let's bring this down to the practical. What are we watching next? We're watching three arenas at the same time. First, the curve. Does backwardation persist or deepen, or does the curve relax back toward contango? Because if the curve normalizes, it suggests the immediacy stress is easing. If it stays inverted, it tells you physical pull is still dominating. Second, inventories, specifically deliverable, not total, deliverable. If registered stocks rise meaningfully, it can relieve pressure. If registered stays tight relative to demand for delivery, pressure stays. And watch the behavior, not just the number. Sudden reclassifications between eligible and registered can be a tell. Not a guarantee, huh? A tell. Third, flows. If ETF inflows remain steady, that's a structural bid. If flows reverse sharply, it can remove a key marginal buyer and make pullbacks nastier. But that's not the only thing. Because the calendar is the catalyst, and you have to treat it like a catalyst. The next 1 to 2 weeks isn't just more of the same in a market like this. You've got month-end behavior. Funds squaring books, rebalancing, risk teams tightening leashes after big moves. You've got delivery cycles and the way participants manage exposure into specific contract windows. You've got liquidity gaps, especially around weekends, where markets can open with air pockets because a big order hits thin books. And you've got product and access changes that can matter at the margin, like new smaller contract offerings that lower the barrier for participation and can increase activity in a way that feeds volatility. None of that guarantees up or down. It guarantees instability. And if you don't price instability into your thinking, the market will do it for you. Now let's talk levels, because this is where the what to do next crowd usually gets lazy. They want a single magic number. Sorry, markets don't work like that. But there are zones that matter because they're where positioning flips. In a move like this, the first obvious zone is the recent high area in the low 90s, where the market has already proven it can attract sellers and profit taking. When price pushes into that zone, you're not just battling sentiment, you're battling inventory of supply from traders who bought lower and want to lock gains, plus systematic strategies that fade extremes. If silver clears that zone and holds, meaning it doesn't just wick above and slam back, then the next psychological magnet is the round number everyone is already whispering, $100. Round numbers matter not because the universe loves them, but because humans and risk systems do. Option strikes cluster, take profit orders cluster, stop orders cluster, headlines cluster. So $100 becomes a focal point. But here, that's the micro cliffhanger. The market doesn't need to hit $100 to behave like it. It's chasing 100. It just needs enough participants to believe the path is open. And that belief can be created by structure, not hype. On the downside, you need a pivot zone where the move either stays constructive or breaks. In a market hovering around the high 80s to around $90, the mid to high 80s becomes an obvious battleground, because it's where recent pullbacks have either been bought or would start to look like a deeper unwind. If silver loses that zone and can't reclaim it quickly, you're looking at a different regime, not healthy pullback, but deleveraging. And deleveraging doesn't care about your thesis. It cares about reducing exposure. That's when moves get violent and fast. So what confirms the bullish physical pull plus shorts cover thesis in the near term? Persistence of front-end tightness in the curve, continued signs of stress and deliverable inventory behavior, steady or improving institutional flows, and price holding above key pivots on pullbacks instead of collapsing. What weakens it? Curve normalization back into comfortable contango, signs that deliverable supply is being replenished in a way that removes the urgency premium, meaningful evidence of industrial demand stepping back faster than expected, or a macro shock that slams the dollar higher and drains risk appetite. And yes, macro still matters. Even in a physical story, the dollar and real rates can whip the screen price around hard. Now, because trust matters, we have to address the counterpoint that's already forming. Silver's up too much, too fast, it's overheated, it has to crash. That's a plausible path. Overheated markets do crash, but overheated markets also do something else. They consolidate at a higher level and then rip again when people get comfortable fading them. The question isn't, can it pull back? The question is, does the pullback relieve the underlying tightness, or does it just clear leverage and set up the next leg? That's the difference between noise and signal. Noise is a scary red candle that doesn't change the structure. Signal is a move that changes who must transact, and that's what you're trying to read. Now let's build your psychology shield, because this is where most people lose money even when they're right. When a market goes parabolic, it creates two emotional traps. Trap 1, FOMO buys at the top because the brain interprets recent gains as safety. Trap 2, panic sells the bottom because the brain interprets recent losses as permanent. Both traps are engineered by volatility, whether intentionally or not, because volatility is the filter that separates disciplined capital from reactive capital. The fix is not pretending you're emotionless. The fix is having a process that acknowledges you will feel it and protects you anyway. That means you stop treating every tick like a verdict on your intelligence. You decide what time horizon you're operating on. You respect that the market can whip around violently, even if your thesis is correct. And you plan for 2 scenarios instead of 1, because a 1-scenario mind gets shattered by a 2-scenario market. So here are the 2 scenarios you should keep in your head for the next week or 2. Scenario 1 is the controlled pullback and retest. Price pulls back into a support zone, call it the mid to high 80s region. Liquidity looks ugly for a day or 2. Everyone screams, it's over. And then the market stabilizes. If the curve stays tight and the pullback gets bought without collapsing through the pivot, that's constructive. It's the market digesting and reloading. In that scenario, you watch for higher lows, for a reclaim of key levels, and for spreads not to relax too much. Scenario 2 is continuation squeeze and gap risk. Price holds above the pivot, breaks the recent high zone cleanly, and accelerates toward the next psychological magnet with air pockets on the way. In that scenario, you watch for signs of forced buying, vertical candles, rising volume, increasing intraday ranges, and the kind of price action where pullbacks don't even give you polite entries. That scenario is where people get hurt because they think they can wait for the dip in a market that's being forced higher by constraints. But here's the warning. The squeeze scenario is also where reversals can be brutal because once forced buying ends, there's no bid under the air pocket. That's why you respect gap risk both ways. Now, where does the calendar fit into these scenarios? It's the amplifier. Month-end and delivery windows can intensify both paths. Controlled pullbacks can turn into sudden flushes if liquidity is thin and a big player de-risks. Continuations can turn into gaps if a level breaks in a quiet session and stops cascade. Weekends matter too, because metals trade globally, narratives evolve while liquidity is fragmented, and Monday opens can reprice risk before you've had coffee. That's not drama, that's the market. Now, I want to pull you back to the hidden detail one more time because it's the anchor that keeps this analysis from turning into a vibes-based pump. Deliverable supply is the lever. When people say, there's plenty of silver, ask them, deliverable to whom, at what price, and under what rules? A warehouse report can show big totals, but if a meaningful chunk is eligible and held by owners who, 1, register it for delivery, the market can still experience front-end stress. That doesn't mean default. It doesn't mean collapse. It means tightness can persist longer than the casual observer expects. And when tightness persists, the paper market has to adapt. It adapts through price, it adapts through spreads, it adapts through incentives. That's the mechanism. And that mechanism is why where we're seeing a narrative shift from silver is just a volatile commodity to silver is behaving like a stressed monetary asset. Not because it's magical, but because the mix of investment demand, industrial demand, supply constraints, and macro uncertainty can push it into a different regime. But that's not the part that matters most. The part that matters most is what you, as a retail investor watching this, do with this information without getting emotionally harvested. So here's your near-term checklist, simple and brutal. Watch the curve. If spot keeps commanding a premium to weight, the physical pull story stays alive. Watch deliverable behavior. If signs suggest deliverable tightness isn't easing, shorts remain under pressure. Watch flows. If ETF demand stays sticky, it supports the bid. If it reverses hard, respect the downside. Watch the dollar and real rate narrative. A sharp reversal there can cause a face-melting pullback even if the physical story is real. And watch the levels. If silver holds above the pivot zone on pullbacks, the trend signal remains intact. If it loses it cleanly and fails to reclaim, you shift from buy the dip culture to protect capital culture. Because the fastest way to get wrecked is to keep using the same tactic after the regime changes. And one more thing, because this is where the audience gets manipulated the most. Headlines will try to turn this into a morality play. Retail mania. Speculative frenzy. Irrational exuberance. Some of that might be partially true at the margin. But the deeper driver is usually less cinematic and more uncomfortable for institutions. Structure? If spreads are tight, if immediacy is expensive, if deliverable supply is constrained, and if margin dynamics force positioning changes, then price can do things that look insane to a headline writer who isn't watching the plumbing. That's your edge. You watch the plumbing. Now, does that mean you go all in? No. That's not discipline, that's adrenaline. Discipline is respecting that this market can whip around violently even if you're right, sizing accordingly, and refusing to let a single candle decide your emotional state. Discipline is knowing what invalidates your thesis and acting like it matters. And here's the quiet truth. Most people don't need more content. They need a tighter filter. If you were the kind of person who rather understand what forces participants to act than chase the loudest narrative of the day, you're already in the minority. Stay there. Keep it surgical. Keep it evidence-driven. And as the next week or two unfolds, don't get hypnotized by the number on the screen. Watch what the market is charging for time, watch what it's doing with deliverable supply, and watch where risk managers are forced to move. Because if this really is silver breaking the old pattern, the loudest part won't be the headline. The loudest part will be the spreads and what they force the shorts to do when the next key level breaks.